The US government has announced that it will fully protect all SVB customers with funds in the bank, regardless of the amount or location. The US government's decision to provide a backstop for Silicon Valley Bank after its collapse is a bailout, even though it does not involve any direct cash transfers or equity injections. A bailout is any action that prevents an institution from failing when it otherwise would have, and that SVB would have failed without the government's intervention. Others argue that it is not a bailout, because it is a rational extension of the deposit insurance system that is funded by risk-based premiums. The US government has created a new bank term funding program, which will provide loans of up to 1 year to qualifying banks that need liquidity support, collateralized by government-backed bonds. The pulse in the news on the bailouts is mixed. Some sources say that the government's action was not a bailout but a necessary measure to avoid a banking panic and protect depositors. SVB's troubles stemmed from its exposure to risky assets, such as venture capital funds, private equity funds, cryptocurrencies, and non-fungible tokens, which suffered huge losses amid market volatility. SVB had also engaged in aggressive accounting practices, such as booking unrealized gains on its investments as income and using off-balance sheet entities to hide its leverage. SVB was not subject to the same regulatory oversight as other banks, because it was classified as a non-bank financial institution by the Federal Reserve. SVB was not classified as a regular bank because it did not operate like one. Most of SVB's investments were in the bond market and other securities that lose value when interest rates increase. SVB also had a high exposure to startups and venture capital firms that were risky and illiquid. SVB's customers were mostly businesses and wealthy individuals who had deposits over $250,000, which is the government-imposed limit for insurance coverage. These factors made SVB vulnerable to a bank run, which is when an unusually high number of depositors want to withdraw their money at the same time, but the bank is not able to meet these obligations, because it has lent out a lot of this money. This is what happened on Friday, when regulators were forced to shut down SVB after it lost $42 billion in deposits in one day. SVB's failure posed a systemic risk to the financial system, because it was a major lender to startups and innovation sectors, which could have faced a credit crunch if SVB went under. The US government stepped in to prevent SVB's collapse by announcing a series of measures on March 9, including guaranteeing all of SVB's deposits, providing emergency liquidity through the Fed's discount window, facilitating an orderly sale of SVB's assets, and launching an investigation into SVB's accounting and risk management practices. These actions measures amounted to a bailout for several reasons. They prevented SVB from facing market discipline. They transferred losses from SVB's shareholders and creditors to taxpayers. They created moral hazard by encouraging other NBFIs to take excessive risks, and they distorted competition by favoring SVB over other banks. The US government has also said that taxpayers will not bear the costs of guaranteeing SVB's deposits, as it will recover the funds from selling SVB's assets and pursuing legal actions against SVB's management. There seems to be some debate about whether guaranteeing deposits is a bailout or not. Some people argue that it is a bailout because it prevents the bank from failing and transfers losses from depositors to taxpayers. Others say that the government's action was a bailout by another name and that it created moral hazard and systemic risk. The public opinion on bailing out SVB is also divided. Some people think that SVB deserved to fail because it took too much risk and lobbied for looser regulations. Others think that SVB was important for the startup ecosystem and innovation, and that its failure would have severe consequences for the economy. The pros of the government action are: it prevents a systemic risk to the financial system and avoids a domino effect of bank failures. It protects depositors' money and restores confidence in the banking sector. It supports startups and innovation that rely on SVB's lending and services. Janet Yellen, the Treasury Secretary, who said that the government's intervention was not a bailout but a decisive action to protect depositors and the financial system. Bill Ackman, a billionaire investor and hedge fund manager, who said that the government's response was not a bailout but a prudent move to protect depositors, and that people who screwed up will bear the consequences. Mark Zandi, the chief economist at Moody's Analytics, who said that the government's action was necessary to prevent a panic and a credit crunch. Brian Foran, an analyst at Autonomous Research, who said that SVB was too important for the startup ecosystem, and that its failure would have severe consequences for innovation. Some of the cons are: it creates moral hazard and encourages risky behavior by banks that expect to be bailed out in the future. It costs taxpayers money and adds to the national debt. It rewards bad management and oversight by SVB executives and regulators. Kevin Muir, an independent proprietary trader based in Toronto, who said that the U.S. intervention created moral hazard and showed unwillingness to let free markets sort themselves out. John Hempton, a hedge fund manager at Bronte Capital, who said that SVB was a poorly run bank that deserved to fail and that its depositors should have known better than to trust it. David Rosenberg, an economist at Rosenberg Research, who said that the bailout was a waste of taxpayers' money and that it would not solve the underlying problems of low interest rates and weak loan growth. Nouriel Roubini, an economist and professor at New York University, who said that the government's action was a bailout by another name and that it would create moral hazard and systemic risk. President Biden said he was pleased that regulators reached a resolution that protects depositors and maintains confidence in the banking system. Ultimately, whether the bailout of SVB will work depends on how well the government can manage the transition of SVB's deposits and assets to other banks or buyers, how much it will cost the taxpayers and the economy in the long run, and how it will affect the behavior and expectations of other banks and investors in the future. Stay tuned to see what happens next in the saga of SVB's collapse.